What's up, investing legends? Today we welcome Daniel, Lin, and Ali Nasr to the program. Daniel is a longtime friend of the program, and today we welcome his business partner, Ali Nasr. The two of them are the co-founders of RiseComm, a real estate investment firm specializing in manufactured home communities. And in today's episode, we dive in deep into the intricacies of mobile home park investing and the competitive advantage that Ali's 40 plus years in the business brings to the table. To kick off the episode, Daniel and Ali detail some of the value add strategies that they're currently using to enhance the returns of the mobile home parks they're currently invested in. Later on in the episode, we talk about the long-term trajectory for this asset class and the 5-year forecast for mobile home parks as an investment opportunity. And then finally, to conclude the episode, we discuss the institutional money that's already moving into the sector and how Ali and Daniel actually see this as a good thing. They don't necessarily see institutional money as a competitor. They see that as a part of their long-term strategy. Really interesting approach there. In this episode, we really get into the technicalities. We get into the weeds of mobile home park investing like we've never done before on this podcast. And as this asset class continues to develop and as we start to see this asset class become more and more popular, I think that it's important for us to get into the technicalities and not only that, but get into the creative strategies that can be used to extract maximum value. And that's what we do on this episode. So without further ado, everyone, let's welcome to the program, Daniel, Lin, and Ali Nasr.
Welcome to the Investing Secrets Podcast.
Daniel, Ali, welcome to the Investing Secrets Podcast.
Thank you. Glad to be here.
Glad to be here again.
Again. You guys ready to step inside the vault with me?
All right, let's do this.
Let's do it. All right. Daniel, this is your second time on, my friend.
Correct.
You were on a wild, like one of the first episodes, and then, but Ali is your new business partner, and Ali, you're joining us now for the first time, and your background is in mobile home parks. Your family, right? This is like a family business. You guys have been running it for a long time, and now Daniel has decided to join you on this journey. So welcome. I'm excited to chat with you. Yeah, man. So right off the gate, I mean, let's talk mobile home parks. You know, there's definitely been, I think over the last maybe 5 years or so, this like flood of optimism in the space, right? Of mobile home parks. This is a great asset class, recession resistant, lots of upside. So from your experience, Ali, kind of like walk me through, because you've seen this, right? Like you're in it before, way before it was like the cool thing to do. So, you know, you've been through various, cycles now of mobile home park investing. How are things different now than they were back then? And is this a good thing or a bad thing that mobile home parks have become more, or the more attention has come upon mobile home parks as an investment opportunity over the last couple of years?
Well, Danny, first of all, thank you for having us. And I'm excited to be here. I know Daniel's raved about the podcast and about you. So this is exciting for me. I'm happy that I can be part of the gold mining, if you would. And so, it's interesting. I've seen this, and you're right. I grew up in this, right? So I was 12 when we got into the business as a family, and going from slumlords and trailer trash to becoming really the darling asset class has been quite a journey. And you typically saw like the M&M 8 Mile, example, to now seeing 5-star communities operated by institutional players and REITs and whatnot, with man-made lakes, or even, dare I say, golf courses and bocce courts and all of that. It's been quite a journey to see all of that. And I have to also mention the change in terms of just, like, for example, financing and structure. We went, because nobody was really interested, we went from just doing seller financed and creative deals, alternative financing deals, to getting, now you can get an agency loan on a mobile home park. And you see larger, not only institutional investors and REITs and private equity groups, but larger lenders and brokers and private, just families, high net worth individuals coming into the space. is it a good thing or a bad thing, to answer your question on the tail end? I think it's a good thing. Anything that brings more attention to the and solutions to the core issue of housing in our country, and in particular affordable housing. When it comes to affordability, we're as good as it gets. For the American dream, if you want home ownership, mobile home parks and manufactured housing communities, which I will use interchangeably, Daniel and I will. The politically correct term and what we're trying to promote for the industry is manufactured housing communities. And mobile home parks and trailer parks is what they've been historically called. And so you'll find me kind of going back and forth. And there's reasons for that we can talk about in terms of the branding. But the answer is, it's a good thing. It's a great thing that there's so much more people coming in, both as residents as a result of the interests of investors and everyone else coming to the game.
I definitely appreciate the sentiment that having more attention drawn to the asset class would certainly help improve debt opportunities in the space, right? Like before, you're saying creative financing, like it's harder to get, a senior debt on these types of assets, and probably even from an equity standpoint too, because of the attention being, that's been drawn to the space. More and more people are now privy to the opportunity that is mobile home or manufactured home, right? If you want to, right, manufactured home investments, I can see from an equity standpoint as well, sourcing equity for these deals could certainly be easier too. That being said, on the flip side, right, more competition, right?
Yeah.
From my understanding, there's about 43,000 mobile home parks around the U.S., right? And there's really not an opportunity for more of these to be built in the future. I could be wrong there, but there seems to be kind of a cap. Why is that, by the way? Just out of curiosity, why is it that there can't be more that are built?
I don't know that there can't be. It's, for us and for the industry, my understanding was the consensus was that it was cost prohibitive. It just didn't make sense to build. And especially when you have, and in particular, in California in particular, for example, the bureaucracy, the red tape, the time, all of it in addition, it was daunting. It didn't really, it wasn't justified and still isn't in most markets, largely because you have the opportunity to have absorption within the 40 to 50,000 communities that are out there now. So most communities stand at 60, 70% occupancy, or that might be like the average, if you would, the median. And it's not because of the lack of demand, right? Because everybody needs affordable housing, but there's other reasons. There's barriers to entry that prevent those spaces from getting filled. And until those vacancies are filled, until we get to 95 or 100%, which a lot of communities enjoy now, but there's a lot of communities that are on the lower end, like 30, 40%, and that's where you get to that median or so of 60, 70. The bottom line is, until we get those existing communities filled up, I just don't think there'll be as much of an appetite on a national level to build. But to your point, or to your question, just in recent years, for the first time, we have seen some development from what I'm hearing in markets like Texas and I believe Florida as well.
Interesting. So, but your sense isn't that all of this increased attention has created more competition in the space, therefore leading to tighter margins, lower overall returns to the investor? Is that something that's come up? Is that something that we're seeing in the space?
Absolutely. Daniel can speak to this. It's something that just like any other asset class, we're going to get, saturated eventually, I would think. And we're starting to see some of that. So if there's any con, that would be the con of more people coming in, that it is more competitive, to your point. Daniel, do you want to expand that?
Yeah, I would say that it's a little bit more difficult of an asset class to get saturated on, mostly because of it all comes down to capital, right? It requires so as most people can already know, the lower barrier of entry creates lower cap rates, and the manufactured housing always will have a pretty high cap rate of, I would say, between 6.5 on the very low end, all the way up to 10, 11 in kind of tertiary smaller markets. And that's because of the barrier to entry. You can't just go get a an SBA loan 10% down and buy it like you can a self-storage. And so you have to have a lot of capital to come in and do a lot of CapEx, bring in, not to say you can't make money off this capital expenditure, which you can, but a lot of people just lack the upfront capital needed to, purchase a mobile home, bring it, to transport it in. And it can be $60,000-$70,000 upfront for a single mobile home, or a manufactured home. And if you sell or finance that to somebody, you're not going to get that money back right away. And then kind of translate that into, if you're doing it for a 300 unit park and you have to do that for 100 homes, times 70,000, you're not going to get back right away since you're extending seller financing. That kind of translates to a lot of money you have to bring upfront to the table, which is kind of eliminates a lot of the potential buyers out there.
So that's one of the. I'm sorry. Go ahead.
Go for it, Ollie.
I was just going to chime in, Danny, to add to that. In addition to the capital, as big of a barrier as that is, and that's the number one, I would agree with Daniel. In addition to that, the nuances, the mechanics behind things. First of all, for example, you're dealing with real property and personal property, right? So the manufactured the home in itself is personal property. It's not real. And so financing or acquiring that, the funding behind that is a different animal versus capital for the real property. And just understanding those nuances, connecting the resources, understanding market price for transportation, for installation, for all of these things, and putting it together, it's not exactly a walk in the park for someone who doesn't have that experience.
Yeah, and you can't get senior debt for that specific thing. You have to get equity lines because it's not real property when you transport a kind of, and that the transport kind of brings in to it geographical difficulties, especially when you have a tertiary market that's far away from a manufacturing facility, or if you have a community that's, you have to, for example, if you go to a community that's located near a Lake Tahoe, for example, and I think about this because I was actually stuck behind a truck transporting a manufactured home down 80 with brakes smoking. Not an exaggeration. I can see the smoke coming out of the brakes, and I was, thank God, behind them, not in front of them. And so I was immediately thinking about, okay, these are the challenges of that hotels and multifamily don't have to deal with.
Yeah. I do want to talk about or cover how the debt is structured on these types of investments, because what it sounds like to me is you've got the land, and I understand that there are some mobile home parks where you are charging like a space rent.
Yes.
Correct. And then others where the property or the space is actually owned by the person who's renting the space, right? Like there's different ways to structure the ownership, right? In the community. Could you guys kind of walk us through like how that actually works? Because I do believe there's multiple ways.
Two traditional methods. The third is a little bit newer. So there's two traditional methods. One is you would own the landlord would own the land, and then he or she would sell the mobile home, and the tenant would live in the mobile home. They would be responsible for everything within the dwelling itself, and they would pay a rent, obviously smaller than if they were in a multifamily, to the owner. And that would be considered, so the that portion of it would be considered the real property. So that would be counted as towards the valuation for senior debt. And the other method, which would be the park would own both the land and the mobile home. And when the tenant rents that, the park owner would actually have to keep a separate accounting system for the mobile home itself, the manufactured home itself being personal property, and the rent that's derived from paying the lot rent, the rent of the land. And when you come to an appraisal, for example, you can include the kind of mobile home rents as a part of the cash flow, but it cannot be included as a part of the value, the net operating income valuation for the value of the park. It's very similar to if you have portables in a parking lot for self-storage. You build portables because you have a huge parking lot. That those are considered equipment and cannot be that cash flow cannot be used to add to the net operating income that calculates the capitalized value of the asset.
Mm-hmm.
And
So Danny,
oh yeah, go ahead.
then what may help what may help, Danny, is you have your lot rent, right? And all the residents are paying rent for the space, for the land, but they own their home. And they may have, by the way, separately, they may have debt service on the home. They may have a loan on the home. That's a separate note payment, whether it's to us or some other bank or lender.
Mm-hmm.
But they're, in terms of the community, they're paying lot rent. And that's what's considered income from real property, like Daniel was talking about, and what is, leveraged in terms of financing and equity. Going back to I think your original premise of what you were asking. So there's the three versions, the three typical models. I mean, one's very rare, actually. Like Daniel said, you have your park-owned homes, your tenant-owned homes, and then you have like a co-op, or I'll use co-op's an example of where the resident may own where the resident ultimately owns both the home and the land. But the conventional model, the one that's been historically practiced, the one that's accepted by lenders, appraisers, bankers, even most brokers, operators, everybody, is the tenant-owned home model. And that's what we have traditionally done as well. So because as land, we use the term landlord, but really, I don't personally like all the typical headaches that come with being a landlord. And that's one of the reasons why Daniel and I are in this space, is because you really have, in essence, the upside of being a real estate owner and having income property. You have all the upside of real estate without most of the typical landlord headaches, because you don't own the home. So you don't have the walls, the carpets to replace, the walls to paint, the plumbing issues, electrical issues. You don't have any of that. Anyway, I hope that helps.
Right. Yeah, no, it does. I guess where I was getting a little confused earlier was when Daniel was talking about, okay, well, it's going to cost like 70, 80,000 for like the manufactured home. But my understanding was that like typically the manufactured home is the tenant's responsibility. Like that's their payment. Yeah. So that doesn't really factor into the investment side of the mobile home.
It's
part, right?
So that's the value add part of it. When you so the analogy would be the BRRRR method, in single family homes or residential and apartments. So in apartments, you would go and you remodel everything, and then you would basically raise the rents, and then based on that the new rental revenue, you can then get that capitalized value and refinance your money out. With manufactured homes, since they're all separate units, yes, you will buy the mobile home because and this is where the capital comes in, and this is where, despite the fact that the manufactured home industry has the lowest default rate out of any commercial real estate class, there are defaults, and it usually comes down to capital. Whether it is people can't afford the deferred maintenance or whatever else that comes out, or it's you can have a mom and pop's park or community sitting there with 10 vacancies, and if they don't have the upfront cash, because the reality of it is that somebody who's shopping for a manufactured home that they can buy on the MLS for $60,000 to $150,000, or in the high end homes, $500,000. let's say somebody is jumping for 100,000 mobile home, they're not going to have 50,000 or 55,000 upfront in cash to purchase a manufactured home, transport it, and bring it into your park. So you have to do that upfront legwork. And so that takes capital. You bring it in, you set it up, and then, yes, you do temporarily own that home until it is sold on the MLS. And that's kind of one of the reasons I love this asset class, is because there's so many income producing arms that you can create within the same asset class. You can bring in the home, sell on the MLS, make money on it because you bought it wholesale, selling it retail, and you can profit from that prior to, say, that 3 to 5 years it takes to remodel every single apartment unit and then get a cash out refi. In this sense, you can make money on every single home that you buy wholesale and sell retail to a tenant.
Okay, gotcha. So now we're talking about two distinct strategies. So
Yes.
The first is we're investing into the land, right? The mobile home park, the park itself.
Yeah.
And then the second, the value add component is this is an empty lot, right? With no mobile homes on it, or maybe like whatever. Maybe
Or-
there's a few
or
on
there's
it. I don't know how that.
30% vacancy, or rather 70% occupancy. A value add with a
Right.
little bit of meat on the bone.
Gotcha. And so then at that point, you would then go bring in a couple of manufactured homes, put them on the like in these spaces. And what it sounds like to me is then at that point, you're selling this, right? You're selling the mobile home to an end user, like an end buyer. But so they're buying it from you at a multiple of what. So you're making quite a bit of money there, and then, but you're still collecting the space right now.
Yeah.
So that's
see.
essentially, so it's a dual purpose, right? In the short term, you're actually you're flipping a home and you're monetizing it in the process. But more importantly, I think what you guys are getting to is you're increasing that occupancy from 70% to 75, 80, eventually to 100%, because now you've cracked the code. You've eliminated that barrier to entry. So people want to move in, can move in, because they can now pay 5% or 10% down to get a 3-bedroom, 2-bath home, move in, and now that you're collecting space rent, so you're really serving your primary purpose of getting that real property to stabilization, if not maximum occupancy. That's really the primary goal. But along the journey, you're actually monetizing this. You're enjoying this other profit center that's benefiting all parties.
This makes a lot of sense to me, because I would imagine that the highest barrier to entry for a lot of these individuals is the fact that they need to find a way to finance this home, right? And get it to the park. So in essence, this strategy is eliminating that barrier. You're funding it. Then they're going to come in with their lender, and it's like you said, right, 5 to 10%. Because once it's on, is there a difference then, guys? Walk me through this, because I'm very uneducated when it comes to this. Is there a big difference then from financing something that isn't in a park already to something that is already in a park? Is it easier to get a loan on that kind of property, before it's in the park versus, after it's already on a space, or in a space? Is that why the finance, or would it be easier to finance once it's inside of your park versus financing it when it's still in the warehouse? Does that am I making sense?
Yeah, I don't know that it is making sense, but I don't know that it's the issue of whether it's easier or more difficult. I think it's more about providing a turnkey solution. And yes, originally there was no financing available by anyone else. For the consumer, there was no consumer. There was flooring and there was financing on a wholesale level, but not for consumers. And so it was absolutely necessary for us to not only bring the home in and purchase it and then provide financing, because there were very limited options. Now there's plenty of options, and the home doesn't necessarily need to already be there. But I think just like any other housing market and whatnot, season or seasonality issues come up, geographic market issues come up in terms of transporting the homes, logistics come up. And so ideally, if we're controlling all of that and making sure that homes are available from maybe April to September, turnkey, ready to go with easy financing, we're just going to accelerate our growth. We're going to accelerate going from 60 or 70% occupancy to 95% occupancy. Maybe we can do it in 18 months. You know, it takes us on average, I would say about 3. We plan for 3 to 5 years, but oftentimes it takes much less than that because we can just accelerate this process. That we're talking about.
I would definitely agree with that. By doing that, you're accelerating. You're putting basically pouring gas on the fire in terms of the time frame it takes for your personal asset to get stabilized. And there's a couple other like dimensions to that as well. Thinking about, I mean, your previous life, you're a realtor, and you've shown houses to people, and a lot of despite because we're in the real estate world, right? So we can totally walk into a house and say, hey, I want to get a fixer upper and I want to fix it up so I can get sweat equity out of this house. But a lot of people are saying, I have my career. I'm a tech worker. I'm this and that. I'm a doctor. Like, I don't even want to remodel a bathroom. I just want it done and find me a house that has everything done already. I don't want to have to do that. And so just imagine somebody like that trying to purchase a mobile home and then arranging a massive truck to transport their home to a park, which is 10 times more stressful than hiring somebody to remodel a bathroom. And so there's also that as well as when, for example, there are lenders out there that will lend equity lines to us in order to go and buy these mobile homes and manufactured homes to bring them in and then repay them once they're sold on the MLS. But there's also underwriting criteria because we can secure it by the underlying asset, and we can secure it with our kind of personal financial statements, which an individual who's shopping for a $100,000 mobile home may not qualify for, and so that makes it kind of a lot more difficult for somebody like that to secure the assistance needed to pull off financing a manufactured home that's not in a park yet.
Go for it, Ollie.
Danny, I'd be missed if I didn't just include one fact in case people are confused about chattel loans versus, fee simple loans. I mean, if this same manufactured home was put on a private lot, on real property and on foundation with a slab, it would be considered fee simple real property, much like your typical any other stick-built home.
Yeah.
And then there's a different whole loan criteria, because since you brought up the loan structure and criteria, then it would be more of a conventional play in terms of financing. But when it's in a community, it's a chattel loan. It's a personal property loan. And loans weren't even historically available. They are now. But anyway, I wanted to just make sure we had that distinction that because it's now in a community, they don't own the real property. The home buyer or homeowner doesn't own the real property, right, underneath. So it's a chattel loan. It's a personal property loan. And for that, and that's by the way, by design, and the beauty of that is that's why we can be at such a lower price point and an affordable price point for so many people, right? Because they get to own their home without having to buy the dirt underneath it. And that's why their prices are so much more affordable versus a regular home, a stick-built home. So anyway, I just wanted to make sure we understood or explained the difference. I hope that helps.
Yeah, no, and I think it's helpful for those who are listening kind of to understand that, because there is a difference there. And it's not necessarily that it's a manufactured home. It's the underlying, like it's where the home is positioned that makes it what it is, right? Which makes a lot of sense to me. Last thing before we move on here, because I do want to move on, but this is all fascinating for me, and I'm assuming if I don't know this, then the majority of the audience doesn't either. So one thing that you alluded to, Daniel, that I want to just like briefly cover, maybe it was you, Ollie. Am I understanding correctly that you being in the space have access to enhanced pricing, right? You said wholesale pricing on these homes versus what someone like could get a home like retail. Like you guys have access to like, I guess, wholesale pricing discounts. Is that correct? Like basically you're getting a discount on these houses as well, which just like increases the margin, or how would that work?
Yes. Daniel, you want to answer? Or?
It's not necessarily, well, it's a couple things. Not necessarily that we have access to things that the average person doesn't. When you just kind of get deeper into it, you just gain more knowledge. For example, just learning that you can go to an auction and purchase a manufactured home, just like the average person is not going to go to a single family auction and purchase. There are people that will, but the majority won't. And just like any other thing, there's also the leverage where if a person who wants to purchase a home to live in, they can go and by all means, they can go and purchase a single home from one of the big manufacturers, have it, transported into the community and set it up. However, if we approach a manufacturer and say, hey, we want to partner up and we have 75 lots to fill up, then we have a lot more leverage to kind of get a lower price per home than somebody else. It's kind of like getting corporate insurance, right? Company has 4,000 employees that you want to buy policies for. You can negotiate that way better than a single person saying, I want health insurance. So with that kind of leverage, we can utilize better per unit pricing than most others. And Ollie, you want to chime in and speak to other?
I do. I think because Danny, this brings up a whole nother aspect to the conversation, which is probably this as we wrap it up, maybe a great segue into maybe what you want to get into, and that is our vertical, right? So we're vertically integrated on multiple levels. Where you have your ownership of the community, the real property under one entity. Then you have your dealer arm. Well, you have your property management and asset management, of course. We have our separate fund, RiseComm, for basically for people who want to get in the game but don't necessarily have the time or the experience to actively invest in manufactured housing communities themselves. So we have the fund, which is another level, and then the dealer arm, and I think that's what you were asking about earlier. In addition to what Daniel talked about in terms of leverage and just awareness and acumen in the game of what is market for a given home, our dealer arm essentially does allow us. It gives us a license to buy homes wholesale if we choose to, and it does allow us to sell retail. So that in our vertical, we also have that arm where we can buy. Legitimately, much like a car dealer, we can show up at and work with. So whereas a consumer may have to go to a retailer, would have to go to a retailer, they can't necessarily go to a distributor. They can't go directly to the manufacturer. They can talk to the manufacturer, but they have to ultimately buy from the retailer. We can skip that, and so that also gives us an advantage. Yeah,
that makes a lot of sense to me. I mean, at the end of the day, once you start to stack all of these different items of value together, I could see how this like all comes together and really creates great returns for your investors. So, I mean, that makes a lot of sense to me. Yeah. And I do want to kind of like get off this and then just get onto some other topics here. From a trajectory standpoint, where do you see the next 5-ish years or so in terms of investment potential in mobile home parks, right? Like in not like the value add component that we're talking about where we're adding, because I feel like that's kind of a niche thing. I haven't really heard of a lot of other people doing that. So I think that you guys are onto something there, but just from like an underlying, like, owning the real estate, space rent, that strategy, like where do you see the next 5 years with this asset class, and how do you see it moving? Daniel?
I see a lot more people getting into it. Because there are a lot of people, even from my personal experience of talking to people going to meetup groups, how back in the pandemic. Pre-pandemic, a lot of them were doing flipping and buying, starting to buy a lot of multifamily. And during the pandemic, basically everybody and their brothers, sisters, nephews, uncles, aunts, former roommate wanted to go and do a syndication in the Midwest. And it's not, obviously it's not quite there for manufactured housing, but it's kind of trending in that direction, and people are learning more about it. There's more information and more education kind of coming out and teaching people about it. Just like the hotels, people have to get educated before they get into it. And then, which then kind of compresses the cap rates, and the supply gets a little bit less. The margins get a little bit less, but that's also actually, in the grand scheme of things, kind of echoing Ali before, it's a good thing, because with all this bureaucracy that a lot of areas have of not in my backyard, and all the kind of lack of incentive to develop from developers, then comes assistance. With a lot of states are starting to, San Jose specifically started relaxing kind of laws and regulations with ADUs, and that was just a kind of the government being forced to kind of look into it, where before it was just kind of like a passing thought. And once the problem of low-income housing gets bad enough, people start relaxing laws and regulations and bureaucracy in order to create this additional housing. And so I think with more people coming in, communities getting more saturated, as Ali mentioned, pushing it up from that 70% all the way up to 100%. It's not surprising to see a lot of parks or communities with 95 to 100% occupancy. And then once it gets to that level, then I think things are going to start opening up, which is good overall for the industry, of allowing, cities to now giving grants and money to developers that are kind of making it more profitable to develop low-income housing, whereas just the deal itself for low-income housing isn't as profitable. And so it's going to kind of create more housing and make it overall better for people, the industry, and just the overall environment.
I just would add to that from a different angle, just to supplement what he's saying, what Daniel's has shared. Danny, and I hope this kind of also answers your question. We've seen now the entry of REITs, institutional investors, private equity groups in the last 10, 15 years. And they've kind of taken over the primary markets across the country for the most part. And then you see on the lower end, the families who originally got into them, even far before my family, the original families that were, the mindset was just land banking, essentially. And then while you're land banking, you might as well have some income, right?
Sure.
And so you're seeing those families, especially as the demographics are playing into this, right? So as the baby boomers are passing on, and passing away, those families are exiting, right? So and replacing the families, many of the families, is what you're seeing. On the high end, you got the REITs, and on the low end, you've got high net worth individuals, and you've got groups like ours coming in the secondary market. We'd like to be in our sweet spot's really the secondary market, and maybe we could talk a little bit more about our sweet spot later. But I think what you're seeing is the mom and pops going away. I mean, the original landowners going away to small players in the tertiary markets, and the huge players in the primary markets, and then groups like ourselves kind of in the middle in the secondary markets, or even kind of in between in some of those areas, like going. So, for example, the dollar range, if that helps the asset value range, would be somewhere between $5 and 15 million would be our sweet spot, even up to 25 million and down even further down to 3 million if it makes sense. But typically, 5 to 15 million would be kind of our sweet spot where we'd have far less competition. And I think in the 5 years, to answer your question, that you're just going to see more of this. You're going to see, these spaces, these areas kind of carved out the way I'm describing.
So what I'm hearing you say, Ollie, is, and by the way, that is something that I wanted to talk about was, the flight of, we'll say, the institutional money, right? So institutional money is now, I wouldn't say saturating the sector, but it's definitely something that I've paid attention to, where you're seeing more institutional buyers come in and take over the parks. What you're saying though is that, yeah, they're playing in the primary markets, and we'll let them do that all day long. My assumption too is that in primary markets, the margin isn't nearly as good anyways, right? Because normally in primary markets, cash flows are it's almost always a speculative appreciation play, like in primary markets, whereas in secondary, tertiary markets, it's more cash flow driven. Right. So am I correct in that analysis, or?
I know you're absolutely correct. You're absolutely correct. I think, I do believe that they'll continue to come closer and closer, creep closer into our space over time. I don't think that's tomorrow, but they originally were doing, from what I understand, $100 million deals in primary markets, 4 to 5 star parks, 5 being the highest and 1 being the worst. So 1 stars like the M&M park I referred to earlier, and the 5-star being, the wonderful ones. So they were typically primary 5-star, 100 million plus. And then you saw them come down to $75 million portfollios.
Yeah.
Then 50 million, and I think, they'll even come down to a $25 million portfolio. And then as soon as all of that's kind of saturated, for lack of a better term, or there's less opportunities, then you might see them creeping into larger deals in the secondary markets and so on. So
I see.
I think that's maybe, I don't know exactly. I mean, I don't have a crystal ball, but probably at least 10 years out, if I had to guess. And then, before they're really, Daniel?
Oh, sorry. And then I was saying that that kind of creates another opportunity for us, is that
Sure.
we can go and we can communicate with the mom and pops, right? That need a value add that kind of is right at the cusp of the institutional level, except we can go and we can take their shoebox of receipts. We can send it to our accounting team, who can kind of reconstruct the financials into something that the institutional funds and the lenders will accept in terms of appraisal, in terms of underwriting. And then we can kind of translate mom and pop's financials into something that the institutional can accept, and bridge the gap between the two, so we can purchase from a mom and pop's something that has the potential to be, in their world, a larger mom and pop's operation. And then we can actually translate it and then bring it up to institutional, and just kind of capitalize on the appreciation and the returns that way too.
I'm so glad, Daniel, you brought that up, because essentially, and it's not just the shoebox. That's absolutely the main part of it. But Danny, that applies to the whole business, right? So all the capex that there's the parks that REITs or institutional investors won't touch, because there's too much risk, too much vacancy, too much capex, financials aren't straight. It's unbankable. All those things come into play where I think Daniel's absolutely right. That's an opportunity for us. We can speak the language of Main Street. We can package, we can update, we can stabilize that park to a degree that's needed to be suitable for a larger buyer, and monetize that profit along the way. So that is part of the strategy.
So roughly translated as the park that needs the PIP for Danny Gold language.
Yeah, no, I understand perfectly. I mean, what it sounds like to me is that, like, you actually see the movement of institutional capital into this world as a positive, where I've talked to other mobile home park operators who have moved out of the space. I actually just had a guy on my show recently who used to do mobile home parks. He got out of it because he was like, he's still he's like, I'm not like out of it, but I'm shifting my focus because all these institutional players are coming into the space, yada, yada, yada. But you guys are actually seeing that as a net positive, because you're not playing in the same sandbox right now, or maybe you're playing in the same playground, but they're in a different sandbox, and they might come over to yours at some point. But by then, we're going to be able to package everything up, get everything to, say, institutional levels, which is actually going to increase the value of the property. And of course, institutional buyers don't need to, they don't need to create that value. They're okay buying something that's already core, stabilized, and have a lower a lower, not margin, but like a lower return on the asset
for the lower risk.
Yeah,
for a much lower risk, and so that's the strategy.
Yeah, so not only are we increasing the occupancy of it, we're also compressing the cap rates to bring it up to like we can buy for 8.5, 9, and we can sell it to an institution for 6.5, 7.
Yeah, that makes a lot of sense.
I get the argument or the sentiment of the gentleman you mentioned earlier who kind of maybe is not as active in the asset class. Sure. Look, I mean, it'd be naive for us to say, hey, it's no big deal. The players the big boys are in and they're buying. I mean, that would be naive. Obviously, we have to be prepared like any other asset class of the risks of being saturated and things being very competitive. Yeah. But we're not afraid of that. And I think in the journey, at least for the next 10, 15 years, there's upside, as we talked about. There's opportunity in it, and beyond that, I think Daniel alluded to it earlier, which is even once a park is 100% stabilized, and even when it's sort of at the cap rate, at a stabilized cap rate, so to speak, there's still different profit centers. There's still things to monetize. Whereas I don't think there's other profit centers in a lot of these other commercial real estate asset classes like we have in this space. So we're not afraid of that.
Yeah. I mean, even in the theoretical world where 100% of the kind of communities are owned by institutions or whatnot, and zero changing of hands, I think we still have enough kind of arms within our kind of company that we can still profit from either flipping or seller financing or whatever, what have you, to kind of in this theoretical world. So we're not too worried about the future. We're pretty confident that we can navigate.
Yeah, that makes sense. And actually, it's funny that you say that, because another thought that I had when you guys were talking about your value add strategy, which is like, hey, we're bringing in these extra manufactured homes and we're going to then sell them to an end user at retail pricing. The other thing that came in my mind is like, well, why don't you guys just seller finance them?
Yep. And we do. That's another strategy. Because just by nature, kind of manufactured homes being personal property, the interest rate is not quite as high as a unsecured credit card, and it's not as, but it's also not as low as a single family house. Back in 2021, where we had to sign documents every time we showed a house during COVID, and the interest rates are 2 5/8. I actually listed a mobile home, and the buyer went conventional financing through a bank because the interest rates were so low, and their interest rate was 7.5%.
When the rates were at 2.5 for single family.
Yeah. Today they're more like 9 to 11% for conventional financing from major lenders, and secondary or private financing is more, 13 to 16%. And just a side note, if I may just kind of throw some disclosures. Obviously, we're not advisors, we're not attorneys, and we want to I think we should throw out that regulations vary from state by state. I mean, in fact, even this industry, the manufactured housing community, is regulated state by state. For example, California, we're regulated by Housing and Community Development, HCD. And so you should know the nuances of your state that you're investing in. And then on the financing side, which is exactly, I'm so glad you brought that up, Donnie, because we didn't tell you that in advance. You're just intuitively, you're doing the math. That's another huge and very sexy profit center. It is something that you want to check, for those who are your audience, just to make sure that it's legal in your state, or what license or structure you need in order to do that. But of course, for us, historically, over the past several decades, that has been just as compelling of the story as the rest of it, as the real property part of it. So
and also for us specifically, and anybody else who was looking to seller finance, you're basically as secure as it gets, and which is why there's such a low default rate. Is number one, the lot rents are significantly lower than if a tenant would rent a multifamily property from you. And on top of that, you're secured by their asset, which in theory can be moved from your land, but in practice, it's not moving. And so they're, number one, not going to risk $100,000, $120,000 asset to skip out on a $1,000 a month lot rents. And so they'll find a way to pay you. And if they can't, their home is sitting on your land. And so you're going to get paid. Like at some point you will.
Essentially, the only bad debt we talked that Daniel mentioned earlier, usually we only see it, unfortunately, when someone's passed away and the heirs are unavailable or don't know or don't understand or just want to, in fact, sell it as quickly as possible and wholesale it and have the monies oftentimes for essentials that they need. So that's the only time you really see a default, because as Daniel said, who's going to give up $100,000 for $1,000 space rent? It just doesn't.
Yeah, but even in that sense, right? The tenant will notify park management when they have an intent to sell, an ITS, and then we can then, if they want to wholesale it, we can then say, hey, we can write you a check. You can be out of here and get this, help you guys out in a time of need where you just want to be out of here in 7 days. And then we can take that, we can purchase that home from them and we can get it, MLS ready and sell it and then resell it.
Yeah, that's actually a really, that seems like that could be extremely profitable then.
Yeah.
If it's like and you're the first ones to always know about it, I'm assuming, right? Or usually
so by law, we can't be the only ones to, of course, it's dependent on state too. We can't be kind of explicitly the only ones that can make an offer to them, but just based on timing, we definitely can be the first.
We get noticed, like you said, and it's not a monopoly. I wouldn't say by any means, but it is kind of, you have this access and you have the ability to assist people in need. And so that combination serves us well, where we can generally, it serves everybody well. Serves the resident well who needs the funds quickly, who may already be in 3 months behind, for example, on their bank's payment because the parents have passed away, for example, and the things fell off the wheels. So now the rent's behind for the community, the bank's behind on 3 months or whatever. They need funds for burial and other essentials. And the last thing they want to do is worry, so we're actually oftentimes a solution for them. They don't want to have, additional debt to worry about when they're already grieving and have this issue that they need to tend to their parents. And so oftentimes we're able to help them quickly, with a solution of buying that home or curing their debt and getting them what they need as quickly as we can. So anyway, it serves all parties, I think, really well. And that's exactly why we have that dealer arm in our vertical.
Well, guys, we are coming up on time right now, and the hour went by really fast.
Yeah,
no, it was good though, because honestly, I've actually learned quite a bit on this episode. I've had a few other manufactured, use your term, Ollie, manufactured home guests before. This is, I think, the most technical I've gotten on this show. So I'm glad that we spent some time on the technical nuances. I think that helps anyone who's just like really looking to get into the space or is starting to explore it for the first time as an investment opportunity, whether they're thinking of buying something on their own or looking at something as more of pee. But before I let the two of you go from the vault, I'm gonna have each one of you. It's not just one of you. I'm not letting either one of you off the hook. Each one of you has to leave us with one final golden secret. Who wants to start?
Ali, I'll let you have the honors.
Oh, wow. So help me understand exactly what you did. So a secret.
One final investing secret, my friend.
All right. I would say it's all about. So one secret. Okay. How do I phrase this? I should have prepared. I guess I couldn't have. But the thing is, I people talk about. Is it a good market? Is it a bad market to buy or sell? And they worry about interest rates and all of these other factors in headwinds or tailwinds. And I would say, to me, none of that matters in the long game. So one secret to success or investing is don't let these market changes be barriers for you. If interest rates are high, that's going to get offset by maybe adjustment in price or adjustment in terms. You can always refinance later. When interest rates are low, you might get better pricing, but then, there may be another element that you need to consider. So I never let, somebody asked me recently at a conference, hey, is this a good time to buy a mobile home park or a manufactured housing community? And I said, the best time was probably, it's like the whole planting a tree analogy, right? The best time was 20 years ago and the second best time is now. Right? There's never a bad time to get started. And I think that would be my message or secret that I'd like to pass on is that don't wait on the sidelines. Let's go. Make it happen.
Love it. What about you, Daniel?
So mine is going to be a little bit more technical. And as everybody knows, we spoke about Ali has been in this his entire life, basically. And he's on to other asset classes. He's done parking lots. He's done companies. He's done appraisal businesses for major corporations. And he always kind of comes back to this asset class. And he's been in it for 44 years, over 44 years. I've been in it for 2 or 3 years. And the one thing we can agree on is we both love this asset class. I came from the multifamily and hotels. And I think the reason why I love it is because, and I got into it because of less management headache, right? I was looking into self-storage and manufactured housing. And it gives you choices. That's the main thing. It gives you choices on as hands-on and as much as you want to make money, you can do that. And as hands-off as you want to be, you can do that too. Meaning you can, there's third-party companies out there that will come out and they'll partner up with you and they will do the value add. They will buy homes, bring them in, do all the work. They'll make the money on that. And then you just sit back, watch your park get filled up, and then watch the rent come in and increase your NOI. And then you can hire full-time park management, and then you can have other companies come. You can contact investors, smaller investors who want to fix and flip, and then have them come to your park, buy homes, keep homes in good condition by flipping them, and they can make the money on flipping the mobile homes or the manufactured homes within your community and keep the community updated. And you don't have to do anything. They'll profit from it, or any of these things you can do yourself. So it's really your choice. Yeah,
you can be as active or as passive as you want to be, and you can outsource that heavy lifting if you wanted. That's great, Daniel.
Yeah, that's awesome, guys, and I do appreciate. It's fascinating because one of the things on this show is I get a wide array of experts, and every week, you could get somebody that have completely differing viewpoints on an asset class, and to be fair, they're both right.
Yeah,
and in a lot of ways they're both wrong, right? Like there's there's so many different nuances here. And I do believe that when it comes to investing, especially when it comes to like, well, what asset class do I pick or what sector do I pick or whatever? The answer is yes. The answer is pick something, to your point, right, Ollie? And then what matters more than anything isn't the asset class, but the strategy.
This is
right. And what stuck out to me about our conversation today is that the two of you have a clearly defined strategy on how you're going to extract maximum value from the investments that you make. And I think that that's actually the most important, right? More important than, should we pick this asset class or that asset class? That actually, to me, seems to matter a lot less.
Yeah.
If you focus primarily on the strategy involved on how you're going to extract the value, I think that's where you win. So
I think I agree with you.
You guys.
A lot of people sit there and analyze, which asset class is going to make me the most money? And they sit there and analyze for 10 years.
But I think I agree with you, Danny, 100%. And thank you for saying it. And that said, I would also add that we win on that front too when it comes to arguments about which asset class. And of course, I'm just a little biased, but I have to say, that if the ultimate equation of any investor, if the bottom line question, the fundamental question you're asking yourself is, where can I get the greatest return for the least amount of risk in the shortest amount of time with the least amount of headaches? I dare anyone in the audience to please educate me and please share with me any other commercial real estate asset class that can give you this with moderate risk and great rewards.
All right. Love it. Well, gentlemen, it's been a pleasure. Thanks for stepping inside the vault with me. And until next time, catch you on the next episode.
Thanks for having us.